What's up, everybody? We are back. It's episode number 9. I'm going to make this short and sweet today. We are going to go into just 5 subjects today, and 2 of them are going to be super quick. So let's talk about IRS layoffs and in general, the government layoffs that are happening right now. BOI, Beneficial Ownership Information Reporting, which has been reinstated now for small businesses. We'll go over that. We've got DOGE, the Department of Government Efficiency, talking about potentially paying dividends back to the American public on their savings now. We got high yield savings accounts and money market accounts that I wanted to go over briefly just to mention them. And then properly setting up rental real estate activities on your tax return, because this has been coming across my desk way too much for comfort this year in terms of things being reported improperly in prior years. So we'll go over these couple of things. And on that note, let's just get right into it. So we've got the IRS layoffs. Now, these have already started, right? You've got the IRS sending emails to their staff. Hey, please come in tomorrow with all of your government issued supplies. And then they come in and then they tell them, hey, you're let go. Now, here's the thing. Yes, it's abrupt. Yes, it's quick. I think people saw it coming. They just didn't know who it was going to be. But who they are laying off right now is just the probationary workers, people who have been there for under a year, right? Now, let me take you a step back for a second. If you remember, under the Inflation Reduction Act under President Biden's administration a couple of years ago, they had the provision that, hey, we are expanding the IRS workforce. We need it badly. We're going to implement another 87,000 new agents, which as soon as the general public heard this, we were all losing our minds, right? Everybody just spiraled. They're, oh my God, everybody's going to get audited. This is going to hurt the little guy. We don't know what's going to happen. Sure, they're going to audit the rich and wealthy too, but also it's going to trickle down into the middle and lower middle class. And then we sat down, we took a deep breath, and we realized, like, hey, they're not hiring everybody at once. There's a 5-year plan for this. This is slowly going to ramp up. Not everybody is being hired as an auditing agent or a fraud detection agent. Because we also needed significant IT support, customer support. It was impossible to get an IRS representative on the phone lines. If you're a tax practitioner, we have our own dedicated line, let alone just being the average taxpayer who's trying to call the 800 number and just not even being able to get on hold, let alone sit for 2 hours on hold just to speak to somebody. So they fixed that issue. Right now, you were able to get through more easily as time went on. It got better and better. But the problem was that we have been, at least this has been my experience, just one after the next, inexperienced workers. It seemed like they got just a couple days of training, maybe even a couple of hours, a script, probably software where they can search up answers to various topics. And when you call them, that's what they're relying on. And most of the time, it's just not enough. And not only that, I would call 3 times throughout the day, get 3 different representatives, either get 3 different answers, or maybe I'd even get 2 answers. And one was just like, hey, I don't even know. Let me transfer you to the next guy, or just hang up on me altogether. Like, some of these guys are nasty and rude, like very nasty and rude. And those of you who know me, I'm always super nice to everybody, very respectful, or at least I try my best to be. And so now DOGE has come in, they're laying people off. So what I expect, here's the problem, is that it's happening during the tax season. So what I expect to happen now is that, again, any kind of notices you guys are getting during the tax season, anything you need to reach out to us for, setting up installment agreements. Maybe you're getting audited and need to get in touch with your audit agent just to, give a little extra time. I think we're going to kind of revert back a little bit, where we're not going to have enough phone representatives. It's going to take longer on hold. And, during tax season, I mean, we're swamped enough as it is, working crazy hours. I can't imagine having to sit for longer on hold to find something out. However, the plus side of it is that they are leaving all of the more experienced IRS workers. So hopefully that will help, and that may actually make things a little bit more efficient if they could just figure out the phone representative situation and the IT situation. Now, from what I understand, a lot of the people that they're laying off are actually in the fraud detection and audit department. So the notion now, I think, is going to be, hey, we're kind of regressing. We wanted to audit the rich and wealthy, and now we might not have the firepower to do all of that because they have incredibly complex tax returns. They have very expensive and competent lawyers who are just going to push the process and push the process and push the process, and the IRS is going to have a more difficult time combating that as they did in the past. So my hope is that these layoffs are kind of a reset. Let's trim the fat. Let's put in a better system. Let's put in better training, and let's get people onboarded again and help things out. That and a combination of upgrading the IT systems would be great, would be wonderful. So that if there's anything to be excited about with somebody like Elon Musk heading up this type of thing and whoever he's got working with him, the engineer on the engineering side of it, is that maybe they'll really work some AI into the IRS systems out and just make things a tad bit more efficient. Make those things that you don't need a phone representative for work better when you go online and not just crash every time you go on, like setting up a simple installment agreement for a client. So that's it on the IRS layoffs. I think that's enough. Now, BOI reporting, the beneficial ownership information reporting, back and forth it's been these past several months. There's an injunction is lifted. There's another injunction from somewhere else. The injunction is lifted. And now the injunctions are lifted. The requirement is reinstated with currently a deadline of March 21st for any of the outstanding BOIs that don't already have a later due date based on the statute because the company was maybe just formed today or yesterday. That'll have the 90 days. Congress is trying to push through a delayed due date to January 1st, 2026. I don't know if I would wait for that at this point. There's too much back and forth. It's too much of a headache. At this point, my opinion is, if you've got nothing to hide, and you should have nothing to hide ever, just do it. Just get the BOI done, get it under the way, get it out of the way. And for future entities that you open, or when you have to make updates to your existing entities, if and when, hopefully there will be other provisions in place, maybe exempting some super small businesses or, giving you a more favorable deadline. So that's kind of it on that. Now, here's kind of the juicy one. The Department of Government Efficiency, dividends, I'm going to put that in quotes because we don't really know what it's going to be called. Now, here's the thing. Yes, DOGE has been kind of scratching the surface, going into various agencies, trimming the fat, like I've said before, saving supposedly lots of money, hundreds of billions of dollars so far. And it's been a month, right? Now, there's a couple of questions to ask. First of all, they came out and said preemptively, like, oh, let's do a $5,000 check. Okay, to who? To people who file tax returns? To all citizens of the United States? To all residents of the United States? To anybody who votes in the United States? How about corporations? There are people who file tax returns and pay income tax, right? Individuals. There are corporations that file and pay corporate income taxes. There are corporations that file and pay tons of payroll tax on the staff that they employ, right? There are all these different levels. And then there's, well, my household might be a household of 2, and your household might be a household of 6, but even in my household of 2 versus your household of 6, we might still only have 2 taxpayers. Maybe it's just me and my spouse, or me and a kid, and you have you and your spouse and 4 kids, right? Your kids aren't filing tax returns. They're not paying taxes. They're too young to work. So there's all these like different various questions. And yes, government goes through a reconciliation process to figure these types of things out. And then if you've listened to one of the more recent press briefings, I forgot who it was that was saying this, but they were like, hey, I think it was one of the news hosts, maybe the Fox news interviewer, who was asking, there was a rumor that it was going to be, 20% of the government savings was going to go to the taxpayer, 20% was going to go towards our debt, and then potentially 60% was going to go somewhere else. Where is it going to go? And the answer was that, that other 60% is just going to go into our next fiscal year. So effectively, it reduces the debt, just kind of in a go-around way. It basically just works towards our budget for next year, effectively kind of reducing the amount of additional funds that we need for the budget. Here's the thing. we have about, and I have this chart here actually. So based on the 2022 tax year, which was filing 2021 tax returns. So this is from several years ago, right? But this is from taxfoundation.org, which is a very good resource if you ever want to go look up various numbers about who files taxes, how many people, what are the, top 1%, 5%, 10%, 50% tax brackets and all of that. So for 2021, out of tax returns, there were 154 roughly million tax returns filed. So if the government wanted to pay out $5,000 to each one of those people who filed a tax return, that's just under $1 trillion that they would be paying out. The government savings so far, if I'm not mistaken, are not anywhere near that. Well, they're high. They're several hundred billions of dollars, but they're not $1 trillion, right? So everything has to, like I said, get reconciled. They have to figure out who's going to get paid. If you made, $1 million in salary that last year, you paid much more in income tax than somebody who made $100,000 or even $50,000 in salary, right? So should the person who made $1 million get one of these checks? What's up, everybody? I just wanted to interrupt for a quick second to say, please, if you're enjoying this, like this video, bookmark it, subscribe to the channel. It really helps me a lot. Share this with your friends. I appreciate you all as always. And now back to the video. So plenty of people will make an argument that $5,000 check, let's just say for argument's sake, is going to be $5,000. It's not going to impact the lives of that $1 million a year earner the way that it would a $50,000 a year earner or $100,000 a year earner. So there's, morals and ethics and equations and all the above, right? And then you got Congress to figure this out and what makes most sense for them, what makes most sense for their constituents, who do they represent, and so on and so forth. All this to say, don't get your hopes up. Don't get your hopes up. Don't count on this. This is different than the stimulus checks during COVID. I do feel like we'll get something because they're so deep in the process now. I don't think that they would allow themselves to not provide us with something. I just don't think it's going to be $5,000 per person or even per household. Don't have your heart set on that. And then there's just the question, the kind of philosophical question of what do you do? Our debt is like $37 trillion, right? Putting these $400 or $500 billion in savings that we've had against that debt reduces it marginally versus what it does to providing the American taxpayer with a refund of taxes that are out. Like, we paid that money, right? They're not creating new money or pulling it from another country to give it to us. It's our money. That was being, supposedly largely misappropriated. And obviously that's up to debate and a lot of it is politics and semantics, but, we can all agree that at least some of it was being misappropriated, and that will always happen. There's just no way. There's no way that it wouldn't. That's kind of my take on the DOGE dividend. Then just a couple things to touch on and we'll wrap this baby up. High yield savings and money market accounts. So there's a lot of clients who have been coming these past couple of years when interest rates have been kind of high, especially. I say interest rates have been high in a good way, actually, because your high yield savings accounts and money market accounts are paying interest on your money sitting there completely liquid, meaning you can get it out of there at any time. You don't have to sell a stock, wait for that to clear, wait for the money to clear, wait for it to come to your bank account and clear. You can just get your money out right away. It's very liquid. That's what it means to be liquid. And a lot of people are not taking advantage of that. I see plenty of clients, both in their businesses and in their personal accounts, cash is just sitting there. It might be $5,000, it might be $50,000, it might be several hundreds of thousands of dollars. And yes, I've seen those cases. And a lot of you are going to be like, wow, I can't believe people are this ridiculous. Like, if you have that much money, how do you not know what to do with it? Some people just, you don't know what you don't know. You know what I mean? And what you should be doing at a bare minimum, and this is not financial advice, this is literally common sense advice. Trust me. If your money is sitting in a checking account, it is not earning anything. It is losing value because we experience inflation every year. As inflation goes up, the value of your dollar goes down, which is why you want it in an account that's at least earning as much interest as what the inflation rate is. So at least your money is stabling out in what its value is in the market. Hopefully you're doing better than that. So high yield savings accounts, money market accounts. If it's in a checking account or it's in one of those regular savings accounts like in Chase Bank or Bank of America or a TD where it's like 0.01 or 0.1% interest, that makes absolutely no difference. When you can be in a high yield savings account or a money market account where you're earning 4%, 4.1, 4.2% right now in interest for doing absolutely nothing, just for your money sitting there, and you could withdraw it whenever you want. It's FDIC insured the same way it would be in your checking account. Please look into that. If you want recommendations of which banks I use for this stuff or which brokerages I use for the money market accounts, please DM me. I'll be more than happy to send you a link. I don't get any referral bonuses. I don't get anything. No affiliate commission, nothing. I just want to help. That's those. Now, the real estate question. So for those of you who have rental properties, for those of you who house hack, you have like a duplex and you live in one unit, you rent out the other one. For those of you who own an RV, a mobile home, and you rent that out for people to live in, whether long-term or short-term rentals, doesn't matter. Time and time again, I see things set up incorrectly. And the consequence of having things set up incorrectly is one of two things or both. Either you're overpaying income tax today because you are not receiving enough in deductions, or the flip side of that, you're getting too much in deductions and underpaying your tax today, or certain deductions are not being taken at all, which are going to come back around to bite you in the ass later on. And I'll explain what I mean by that. One of arguably the largest tax deduction, or we'll call it a write-off, an expense on a rental property tax return schedule is something called depreciation. Any asset you have, your house, your car, your camera, your phone, your laptop, the flooring in your house, the roof, the kitchen, the appliances, you name it, every asset has a useful life that the IRS determines for it. The useful life is basically, on average, how long should this asset last before you have to do a major improvement to it. Residential homes are 27.5 years, your computer is 5 years, your car is 5 years, and the list goes on and on. You can Google this, useful life of assets. It will come up, and there's many different categories, and you'll see what's what, just so you can check yourselves and check people like me on this. Now, what that means is, obviously, if a house, let's just use a house in this example since we're talking about real estate. Let's say a house is worth $100,000. That's what you bought it for. If it's depreciating, if it's losing value over 27.5 years, that means you take the value of the structure of the home and you divide it by 27.5, and every year you take that portion, the 1/27th, as an expense on paper against the rental income that you're receiving for that property, whether it's a commercial property, a residential property, a mobile home, doesn't matter. It just, the years and the deductions might be different, but this depreciation still exists. So the problem I see is, first of all, land cannot be depreciated, does not get depreciated, okay? So if I buy a house for $100,000, that includes the land that it sits on. If I turn that into a rental property and I want to put that on a rental property schedule, I have renters in there, and I want to depreciate it, I first have to separate the value of the home that's above the land, the structure and everything that's inside of it, and then the land below it. Whatever the structure is worth is what you depreciate. Now, there's different ways to do this. You can get an appraiser who's going to tell you it. You can look at property tax records with your county and how their appraisers do it, and take a proportion based on what they appraise things at and their percentage of the value of the land to the entire value of the home, and do it for yours and depreciate that. So one of the issues that happens is that people's accountants don't separate out that land value. Because of that, they end up depreciating too much, and under audit, they end up paying tax dollars back. The flip side of this thing is The accountant might not put in every expense that should be accounted for in the value of the home before you start depreciating it. Any improvements that you had to make, certain closing costs can be added into what's called your basis in the home, your equity, what that home cost you in the beginning before you start depreciating it. As time goes on, people are living there. Let's say, 5, 10 years pass by and you're like, oh shit, I need to redo the kitchen, or I need to build a deck in the back of the house. I need to do a significant improvement to the house. When those are done, these things get capitalized and depreciated. So whatever the cost was to build that deck, whatever the useful life of that deck is, it gets depreciated. If you had to do the floors, same thing. If you had to do walls, take one down, put a new one up, same thing. The roof, same thing, and so on and so forth. It's very important to do that. Here's the other mistake that happens, and this is the bigger one. Depreciation is not taken at all. And I'll tell you what the problem is with that. The IRS, their rule is that, so you bought a house, years go by, it's being depreciated, that's one of your expenses. Depreciation reduces your basis, your equity in the home. So if I bought a home for $100,000, over the years there's been $10,000 of depreciation. On paper now, for tax purposes, for when I sell, the cost of that home to me was $90,000, not $100,000, in determining how much profit I'll have on a sale of the home. Okay. If depreciation is not taken, you did not receive the tax benefit throughout the years. You didn't take the deduction, so you didn't save tax dollars on it. But upon the sale of that home, the IRS still expects you to recapture, add back in that depreciation and pay taxes on it, whether you initially got a tax benefit or not. And cleaning up that mess is a world of pain for us emotionally and for your pockets to pay for all the amendments that have to be done. So when you hire a tax preparer or anybody to prepare a tax return for you, that's something you need to look for on your tax return. Make sure there's a depreciation schedule. It shows how much was taken this year, when the property was put into service, how much should be taken next year. Just ask some questions. Just ask some leading questions to make sure your tax professional knows what they're doing. Get a second opinion, go online, do a little bit of research yourself, but these are things that I feel like you need to look out for. That's pretty much it. That's kind of what I wanted to touch on today. As I always say, thank you so much for your support. The viewership has been going up a little bit. I hope it continues to do so. I'm considering switching these to just going live once or twice a week, probably, in the evening time sometime. And we'll take it from there. Please like, share, subscribe. Even if you're not going to pay attention to the notifications you get, it really helps me out a lot. It shows me that I maybe kind of know what I'm doing. Maybe my information is valuable to you. Maybe some episodes more or less than others. But it really helps me out. So I would appreciate that. Guys, thank you very much. I'll be back next week. And that being said, I'll see you soon.